Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Logitech stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Logitech is a computer, peripherals, and software company. It is one of the world's leading manufacturers of input and interface devices for personal computers and other digital products. The company develops and markets personal peripherals for PCs, videos, music, and smart homes. This includes products like keyboards, mice, tablet accessories, webcams, Bluetooth speakers, and more. The company is headquartered in Switzerland and was founded in 1981. The ticker trades on the Nasdaq, Mexican Bolsa, Deutsche Börse, Swiss, and London Stock Exchange. Let's get started with the model. This is a mid-cap company, 8.6 billion market cap. They're trading at $52 a share, and they have 165 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a lot of free cash flow in 2021, 1.4 billion. It's down to 200 million in 2022. Their accounting period just ended. Their 2022 fiscal year is 4/1/2021 through 3/31/2022. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also highest in 2021, 645 million in 2022. Revenue is the sales for the company, and that's doubled from 2019 to 2022. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are all the expenses directly related to generating the revenue. Revenue minus cost of revenue gives you the gross profit, and that more than doubled from 1 billion to 2.3 billion. But their revenue almost doubled from 2019 to 2022. That means their margins are higher in 2022 compared to 2019. Gross margin is gross profit divided by revenue. It's how well you convert your revenue into gross profit. Then below that is their operating expenses. I think they spend a lot of money in marketing. Gross profit minus operating expenses gives you your operating income. And that was much higher in 2021 at 1.15 billion. It's about 800 million in 2022. And they had higher revenue in 2022. So their operating margins were much better in 2021 compared to 2022. They don't have any debt, so they don't pay any interest on their debt. They did receive 1.2 million of interest on their investments. Then you have other income and expenses. These are all the gains or losses not part of the company's core operations. They had a loss of 5 million. Your pre-tax income, your taxes, and the bottom line of the income statement is your net income, which is higher than 2019 and 2020, lower than 2021. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. They generated less cash flow in 2022 compared to the prior 3 years. The most in 2021, 1.5 billion. Then you have capital expenditures, investments in property, plant, and equipment. They do manufacturing, so they have to build out factories and buy equipment and machinery. The cost of that stuff goes into CapEx and is carried on the balance sheet and depreciated onto the income statement over its useful life. Operating cash flow minus CapEx gives you your free cash flow. And that is positive every year, but pretty low in 2022 compared to 2021. They do pay a dividend with their free cash flow, but another way to reward shareholders is to buy back stock. When a company buys back stock, it decreases the shares outstanding and makes your shares more valuable. They bought back 400 million in 2022, 165 million in 2021, 50 million in 2020, and 32 million in 2019. Let's look at their capital structure. 2.4 billion of equity and no debt, so they're 100% equity. Their net debt is negative 1.3 billion. That means they have 1.3 billion of cash on their balance sheet. And the WACC on Finbox ranges from 6.3% to 7.8%. I use the middle one of 7%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 20 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $18 billion. We divide that by 165 million shares. And we got a calculated stock price of 111. They're trading at 52, so they're trading at a 54% discount. It's a strong buy according to the model. Their revenue target for 2025 is $6.3 billion. For 2024, it's $5.9 billion. For 2023, it's $5.6 billion. I continue this growth into 2026 and I got $6.6 billion. That's how I got their future revenue estimates. They convert on average 14% of their revenue into free cash flow, so I multiplied their future revenue estimates by 14%. That's how I got their future free cash flows. It looks like the website Simply Wall Street is pretty close to me. They're at 121. They're saying the stock is 57% undervalued. 6 analysts priced this stock and the average price target is 81, the lowest 53, the high is 95. Here's where the stock has been trading the past year and a half. Its highest point was about 135. That was in June 2021. But it's really gone down a lot since that point. I feel bad if you paid more than $100 for this stock. But it's a really solid company, so it should come back anytime. But most tech stocks are getting destroyed. So it's a tough time to own tech stocks. I know I've gotten killed in some of my investments. They pay an annual dividend. It's 94 cents a share, which is a yield of 1.8%. That's 74% of their free cash flow, 24% of their net income. Here's a list of their dividend yield since 2013. It did get close to 4% in 2015 and 16. And the forecast is for the yield to be 2.4% by 2025. The last time they did a stock split was in 2006, a 2-for-1. Then a year before that, in 2005, another 2-for-1. And then in 2000, a 2-for-1. All in the month of July. They have a pretty low beta, 0.7. The stock's gone down 58% in the past 52 weeks, while the S&P is down 12%. The 52-week low is 51, the high is 128. And the stock is on a major downtrend, trading below its 50-day and 200-day moving average. 1 million shares are traded each day on this stock. Of the 165 million shares outstanding, 163 million are on float, 61% are held by institutions, and 7% of the shares are shorted. If you invested $10,000 into this company 10 years ago, you'd be pretty happy at $65,000 today. That's a 550% return, a 21% annual return. But just a year ago, your investment would have been $140,000. The CEO's annual salary is $1 million and their total compensation package is $11 million, which is up a bit from 2020. There's only one insider trade in the past 12 months, a sell for $61 per share, which is $10 above today's price. The general public owns 55% of the company, 45% by institutions, and 0.7% by individual insiders. Their employee count was pretty steady from 2016 to 2020. Then it jumped up in 2021. It's come back down a little. They're currently at 8,200 people. Capital Research is the biggest shareholder at 3.4%. Then Vanguard, Credit Suisse, ZKB, Credit Suisse, Invesco, Amundi Asset Management. The best way to look at ratios to compare them to companies in the same industry. There are 37 companies in the same industry as Logitech, and if Logitech has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. They do spend a lot less in CapEx than the average company. That's surprising because they do manufacture their own products. They have no debt, so they have a 0 debt to equity ratio. Not that many companies in this industry pay a dividend. They do, so it's higher than average. They didn't generate much free cash flow in 2022, smaller than average. They rank 8th in market cap at $8.6 billion, but they were over $20 billion about a year and a half ago. Their price to book is average. They have a good price to earnings, better than average, but their price to free cash flow is worse than average. Price to sales is really good, a lot better than average. They generate less revenue than the average company. Their 5-year annual revenue growth rate is strong at 20%, average is 12%, and they have a good ROA and ROE. So to summarize, I have them trading at a 54% discount, and who doesn't love Logitech products? Right now I'm using their microphone and mouse while I do this video. And the company really blew up and got a lot of new customers from COVID because so many people are stuck in their home, so they had to buy Logitech products. So I think this company has a great future. I rank their free cash flows 4 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.